Hi, this is Greg Gornert of Gornert Wealth Management, and this is my Insights and Perspectives podcast. Hi, and welcome to the October 26th edition of my Insights and Perspectives podcast. This episode will feature my Investor Toolkit segment, so I'll be joined from Montreal by Canaccord Genuity Chief North American Strategist, Martin Roberge, and it's all about protecting your wealth.
While the economy is not on the verge of going into a recession in the near term, it is still downshifting at a very slow pace. It's like a Chinese water torture drop.
Now, before we turn it over to Martin, I wanted to thank all of you again who came out to our Tony Dwyer event presentation last Thursday. We had a fantastic turnout, and it was a great event. And for those of you who missed it, you can still get an update from Tony by going to the podcast page on my website, greggornert.com. That's GREGGOERNERT.com, and listening to my September 15th podcast interview with him. Now, let's get to the update. Well, my guest today is Canaccord Genuity North American strategist, Martin Roberge. Welcome, Martin.
Welcome, and thanks for having me.
You're very welcome. You've put out a great report in your October Quantitative Strategist report. You're talking about the global economy, having persistent softening, and I just want to talk about your thoughts there, your asset mix ideas, and maybe take it from there a little bit.
Yeah, the big challenge we have as an investor is that we're dealing with an economy that is drifting, as opposed to like when you go back and revisit history. Normally, recessions are pretty abrupt, and they always happens because of a monetary overkill. This time around it is somewhat different. It is caused by a global weakening in manufacturing hubs such as China, such as South Korea, Southeast Asia. So while the economy is not on the verge of going into a recession in the near term, it is still downshifting at a very slow pace. It's like a Chinese water torture drop.
Yeah.
And the problem we have is that as an investor, we don't know how to deal with this softening, because this is something unprecedented. And even though we've seen a lot of stimulus from central banks, the unweighted global growth average is at 1.9%, which is like the lowest level since 2011, 2012, and all the leading indicators that we look at are still pointing to a further slowdown. So from a risk reward point of view, it feels like the market will continue to grind and churn until we see a reacceleration in growth, or will eventually become at risk of a full-fledged recession. So net, this is a market which is likely to get sold if there is a pocket of strength, but at the same time could be providing buying opportunities if there's a sudden correction, because odds of a recessions are still below 50% in our view.
Yeah, and that's interesting because you brought up the whole sector rotation argument, going, is this a temporary value bounce or is it a trend change? And I think I know myself, it's hard to get my head around exactly where we are in the market, because it does seem to be this drip, slow deceleration. The U.S. still seems to be standing, but I mean, there's a lot of headwinds out there, and there's a lot of stimulus coming out around the world, and it's just hard to figure out where the crosswinds are going and how to position ourselves. So can you help us with that?
Yeah, so the one thing is for sure is that if you look back at, again, a historical bull markets, it would be really unprecedented to have a full bull market without a value cycle.
Yeah.
Like it's like it would be unprecedented. There's always a value cycle somewhere in the through a bull market. And one of the reasons why we haven't seen one yet is due to what I believe is the compounding impact of corporate buybacks. If like we did some analysis this summer and realized that most corporations which are buying back stocks are growth companies, and most companies that are issuing stocks, or net issuer of stocks, they are value companies, except for financials. So it's really difficult to see value taking over growth unless growth companies are losing their relative buyback power. Now, we could be at this point, like we could be at this inflection point where growth companies, because profitability is declining, they don't have the same relative buyback power than in the past. Actually, if you look year over year, corporate buybacks are down about 20% in the U.S. So if the buying power of growth companies is waning relative to value, well, you could have value stocks relatively outperforming. And if on top of that, there's a concern that we've seen the low in bonds and yields keep on rising, well, this is obviously positive for value stocks. So we are, I think, in a sweet spot for value to take over growth. I'm just questioning the longevity of that cycle, but it could take us till the end of the year, that's for sure.
Yeah, I mean, that's interesting because I've been waiting for the value to move. But so if I'm reading what you're saying correctly, the historically low interest rates, and in some cases negative interest rates, are allowing corporations on the growth side to go out and buy back stocks at favorable terms to them. So this is once again prolonging this whole growth cycle. And it's hard to figure out where we're going to get to a point where it doesn't have any legs anymore. And is it going to have a rapid just drop off? You saw a 20% decline over the past year.
Past year, yeah.
Yeah. So at some point, there's going to have to be a point in my mind that the music stops, and you got to make sure who's got chairs.
Well, I think the clock is ticking. Again, as I said, like 20% is down year over year. Mm-hmm. But if you look historically, the best predictor for corporate buybacks is the free cash flow of U.S. corporations and the growth. And as you know, this free cash flow growth has turned negative, and because the slowing of the global economy. And if you look at corporate growth forecasts for Q3 and Q4, there's no recovery in sight. So you have to believe that corporate buybacks in Q3 and Q4 will be very, very mild, which favors something that favors value over growth. Like growth will take over value again, but this is probably in the next business cycle when profitability recovers and the global economy starts a new cycle. But there's a long way before we go through this upturn. So one thing is for sure, when it comes to playing the tail end of a bull market, the way to go is value, even through a bear market, and then sometimes through a bear market, this is when you start rotating back into the growth as corporate profitability bottoms out, and then a new cycle begins. But from today till the end of this bull market cycle, investors should have a value bias in their portfolio. That's for sure.
Yeah, agreed. And one thing about corporate share buybacks, in my experience, and I've been doing this 25 years now, you never see companies buying back their stocks at the lows in a bear market. You always see them doing buybacks when things are really good. And that's always a danger I keep in mind.
Yeah, it's something that, that this is something like not necessarily new, but CEO's compensation is 100% related or dependent on corporate profitability, such as return on investment, return on equity matrix, and actually this is why we're seeing net buybacks in the U.S., while outside the U.S. It's the opposite. Corporations are net issuers because like CEOs' compensations are not tied to corporate profitability. So for them, for U.S. corporations, some of the CEOs don't really care about the valuation and the dilutive impact of buying back stocks way above book value, because the matrix that they are paid against is the earnings profitability, and as long as you buy back your stocks, well, you diminish your share count and you create financially an artificial boost to your earnings growth. And as long as people don't care about this financial engineering, the music keeps playing. But eventually, the problem comes when, as I just mentioned, the free cash flow of these companies is slowing down or decelerating because of the cycle being turning around, and eventually corporate profitability crunching are not allowing them to buy back as many stocks as when earnings were growing at a fast clip. We're talking about earnings growth near 1-2% right now. This is not the same pace we had last year when we could enjoy the fiscal boost.
Well, and that's the thing too. I think that in my mind that's part of a part and parcel of just such a long bull market that a lot of people forget what happens, and they become kind of numb to the fact that there is financial engineering, there are incentives, there are unintended consequences. And if you have the numerator and the denominator as far as shares go out, if you start buying back your shares, you actually reduce the amount of shares outstanding and actually artificially improve what things look like. And it all looks great. And we've seen this. I don't know. I'm sure you've seen it before. I've seen it before. But at the end of the day, people don't care. Investors don't care until they care. And they all care on one particular day. And it all kind of, the theme changes.
That's why it's very important for your investors, and this is another issue or challenge. Many investment advisors are paid to beat the market or to do as much as the market, but at the tail end of a bull market like the one we've enjoyed for the last 10 years, the key is to avoid another like 20% or 30% drop in portfolios. So I think the relative performance game has to end like here, and focus on absolute returns as opposed to relative returns. And that means maybe sacrificing some of the upside left to make sure that portfolios are defensive enough to fall less in a down market. And if the market was to keep on rising, well, instead of clipping double-digit returns, well, maybe clipping 6-7% is good enough. So this is how I view the whole money management process at this time of the bull market, giving up some upside potential to protect and preserve capital. So capital preservation, in my view, outweigh capital appreciation at this stage of the cycle. And again, this is just to guard against, as you mentioned, capital dislocation. If all of a sudden odds of a recession were to move beyond 50%, we know that the average correction through an economic recession is 23%. So we must guard against this possibility. And again, building portfolios in the defense. It doesn't mean to raise cash to the limit, but it certainly suggests to keep a good balance of your holdings in high dividend payers and stocks that are valued on the low side of things, especially in the value universe.
Yeah, no, I agree. I think that we're coming to a time when protecting the wealth you've built is more important than growing your wealth. Now, let's just pivot onto Canada. Canada typically is a late cycle economy. We're rocks and trees. Where do you see us going here? Because the Canadian performance over the past 10 years has been atrocious versus the U.S. markets. What are your thoughts?
Yeah, I think it's going to continue to underperform until a new cycle begins. As you said, this is a resource-rich country, and as I said earlier, most companies in the value space have very low corporate buyback power. And as you know, people have been selling their Canadian holdings for years. If you look at foreign investors, they have been scaling out of Canada for a little while now. And even in Canada, mutual funds are facing redemptions like month after month. So there are no net new buyers of stocks in Canada. Like you got the ETFs a bit, but that's really not enough. So Canada is stuck between a rock and a hard place because you've got this late cycle risk, the global economy slowing down, Canada being very sensitive to global growth because of the high resource base, and at the same time you've got this situation where valuations outside Canada are much better, cheaper. And they don't have this high resource content in their benchmark, so it's a no. I think it's a no-brainer to overweight international equities relative to Canada. That's probably the easiest call to make. And then Canada versus U.S., we're a little bit more neutral, but Canada versus the rest of the world, we favor the rest of the world.
Interesting. Now, last call that we had, we talked a little bit about your gold call. You had been very bullish on gold in years past, and now that we've started to make some moves, you backed off on that a little bit for obvious reasons, that it wasn't a strong conviction anymore at the movement. So where do you see commodities, in particular precious metals and the base metals?
Yeah, the gold will be consolidating in the near term. We had a really good push. The stocks, the stocks are up almost 40% year to date, and we had a really strong push from the 1200 level. But now that bond yields are rising a bit, because I think the bonds have been coming down way too fast. Forecasting nearly a recession this year, which I believe is wrong. So you have to unwind the overbought conditions of the bond market. So you need to see a little bit of a backup in yields, and then there will be eventually what I call the put option, or the end of the economic cycle play on goals. And this is no longer going to be a play on the bonds, but an option or a put option on the economy, which could be headed into a recession. Again, our indicators are still not above the 50% line, but they I would say probably high 40s. So once you get the confirmation that there could be a recession next year, this is when you're going to get the next leg, which is what we've labeled phase number 2. Right. And historically, when you look at bull markets and gold, you've got always two phases: a strong phase 1, consolidation, and a strong phase two. But the phase two usually occurs like before the recession and through an economic recession. So we're not there yet, but like the consolidation that we're seeing is good news, because we have to build another energy point for the sector to eventually pop into a higher range. And the catalyst will likely be when we've got odds about 50% that we enter a recession next year or early in 2021.
Perfect. Now, for everyone listening, I'm actually linking Martin's report from, I think it was a year ago, when he laid out the multi phases of the gold market in the links below. So please take a look at that. It's a great report, and it's proven itself over the past little bit. So, Martin, any final thoughts on where we are right now going forward for the general investor?
Well, we're late in the business cycle, extremely late. We're late in the late stage of the business cycle, okay?
I feel like a broken record because I've been saying that for a year. It's like, okay.
And recessions are natural, and we're looking at the economy, and we've got pundits arguing left and right, will there be a recession or not? But one thing is for sure, even though we could avoid an economic recession, there should be a profit recession. And already a profit recession is at least a yellow flag, if not a red flag. So this is certainly not time to be a hero and be willing to sacrifice or give up a little bit of upside to avoid those situations that could take your portfolio 20 to 25% down, because odds of a recession in 2020, we believe, have never been so high in this business cycle. And while people are mentioning that positioning is very bearish and the sentiment is very bearish already, so it's a good contrarian indicator. Well, folks that we talk to are institutional folks, and they're not positioned defensively. And actually, for them, the upside risk of eventually a trade deal between U.S. and China is as high as the downside risk for recession. So net, they're neutral and hugging their equity benchmarks. But if there was to be a deal, that would remove a big carrot, okay? And they would probably be more tempted to sell that deal than to buy into it. So I'm concerned about a sell on the news reaction if we do have this deal. So again, be careful. Trim on the upside, and take your time be willing to play or buy some opportunities that could arise should a correction unfold.
Okay, so just to wrap it up, thanks so much for the time. Great insights as usual, and au revoir today. Martin Roberge.
Okay.
Thank you.
All right.
Bye.
Bye.
Hey, thanks for listening. Don't forget to subscribe and visit us at our website at greggornert.com. That's GREGGOERNERT.com. Thanks again.